You know, every now and then, something happens quietly in the background of global finance. Something most people never notice. But that moment ends up changing everything. And just a few days ago, one of those moments happened. The United States Treasury held a massive bond auction, offering $119 billion in government debt. And for the first time in a long time, the world didn't seem that interested in buying. Now, that might sound like a technical detail, but make no mistake. This is the kind of event that can reshape economies, shake confidence in the dollar, and eventually hit your mortgage, your savings, and your retirement. This wasn't just another bond sale, this was a warning shot. The kind that tells us America's financial foundation is starting to crack. Before we go deeper, take a quick second to like this video and share it if you find this kind of deep dive helpful. It really helps the channel reach more people who want to understand what's actually happening in the economy. Alright, let's break this down, simply, clearly, and without the jargon. So, what really happened? Every few weeks, the US government sells bonds to raise money. Basically, IOUs it issues to fund spending that exceeds its income. That's normal. The US has done it for decades. But this time, the auction didn't go smoothly. Investors hesitated. Demand was weak. The Treasury had to offer higher interest rates, bigger returns, just to convince people to buy. Now, when that happens, it's like a borrower who suddenly has to offer a higher interest rate because the bank isn't sure they'll pay it back easily. It's a confidence problem, and that's dangerous. Especially when it happens with long-term bonds, not like the 30-year treasuries, which are supposed to reflect faith in America's future decades ahead. When investors pull back from those, it's a signal that the world is no longer certain the US can manage its finances responsibly over time. And that's a very big deal. So what's driving this sudden hesitation? It's not just one issue, it's three powerful forces colliding at once, all putting pressure on the Treasury market. First, the national debt has exploded past $34 trillion, and it's still climbing. That means every year the US has to pay more just to service that debt. In fact, America now spends more on interest payments than on national defense. That's not sustainable, and investors know it. They're looking at Washington and wondering, when does this stop? Second, the Federal Reserve, which used to be one of the biggest buyers of US bonds, has stepped away. During the pandemic, the Fed bought trillions in treasuries to stabilize markets. But now it's doing the opposite, selling off bonds to fight inflation. That leaves the Treasury without its biggest safety net. Third, foreign buyers, especially China and Japan, are backing off. China dumped over $100 billion in US bonds last year alone, and Japan is selling too, partly to protect its own currency. These two countries used to be America's most reliable lenders. Now they're signaling caution. So the Treasury is left standing in the market trying to borrow record amounts of money, with fewer buyers and higher costs. Now, you might be thinking, okay, but I don't trade bonds. Why should I care? Well, here's why. Treasury bonds aren't just government IOUs. They're the backbone of the global financial system. Banks, pension funds, and insurance companies treat them as the safest assets in the world. They're supposed to be risk-free, the foundation everything else is built on. When confidence in those bonds cracks, it doesn't stay contained. It ripples through every part of the economy. Here's how that ripple hits you. When the Treasury has to raise yields to attract buyers, that sets a new standard for all other interest rates. Mortgages, auto loans, credit cards, business loans. Everything becomes more expensive. If you're trying to buy a home, your mortgage payment goes up. If you're carrying credit card debt, your interest charges climb. If your city or state borrows money to build infrastructure, their costs rise too. And that eventually trickles down as higher taxes or service cuts. So when demand for Treasury bonds weakens, it's not just a Wall Street issue. It hits Main Street hard. Here's where things get worrying. When the US borrows more, it has to offer higher yields. Those higher yields increase the cost of borrowing. That means the government owes even more the next time it sells bonds. And the cycle repeats. That's called a debt spiral. It's the same trap that's brought down many countries before, from Greece to Argentina. And while the US is far from that point, the pattern is starting to form. And remember, the only reason the US can get away with this for now is because the dollar is still the world's reserve currency. But that status isn't guaranteed forever. Countries like China, Russia, and even the BRICS alliance are already building systems to trade without the dollar. If confidence erodes too far, global investors could start moving away. Slowly at first, then all at once. When that happens, the consequences will be historic. Quick pause here. I want to hear your thoughts. Do you think America can still control its debt problem, or are we already past the point of no return? Drop your opinion in the comments. I read every one of them and they help shape future videos on this topic. Alright, let's look at how this might play out next. The Treasury's auction didn't break the system, but it cracked the surface. From here, two paths are possible. Best case scenario. The Treasury restores demand by offering reasonable returns. The Fed carefully lowers rates without reigniting inflation, and confidence gradually returns. That's the soft landing. But the worst case scenario, the one many analysts quietly fear, is a cycle of rising debt, rising yields, and falling confidence that could lead to something close to a bond market revolt. That would trigger chaos in global markets, and the effects would show up in everything from 401ks to grocery prices. If the government can't find enough buyers for its debt, it has one last option: print more money. But that's just another word for inflation. And when inflation returns while growth stalls, we get stagflation. High prices, low growth, and shrinking savings. That's the nightmare combination we haven't seen since the 1970s. So what can ordinary people do in the face of all this uncertainty? First, take a look at your debt. If you have variable rate loans or credit cards, consider paying them down or refinancing while rates are still manageable. Second, diversify your savings. Don't put everything in one place, especially not in assets that depend entirely on the dollar staying strong. Third, stay informed. Understanding how these Treasury moves affect your money is the first step in protecting yourself. And finally, keep an eye on inflation. Prices can rise faster than interest rates on your savings, so real purchasing power matters more than numbers on paper. We also have to recognize that this isn't just an American issue. If foreign governments lose trust in US bonds, they'll start buying less. And that means less demand for dollars globally. That could weaken the currency and make imports more expensive. Everything from cars to medicine to electronics. So what starts as a bond auction in Washington can quickly turn into higher grocery bills in your kitchen. That's how interconnected the system really is. The bottom line is this: the US Treasury's bond auction wasn't just a number on a chart. It was a test of confidence. And while the bonds were eventually sold, the hesitation from investors spoke volumes. This was a signal that America's long-standing financial credibility is being questioned, not just by rivals, but by its own investors. Whether this becomes a turning point or just another warning ignored depends on what happens next. Fiscal discipline, smarter monetary coordination, and rebuilding global trust. These aren't optional anymore. They're essential. Because if the cracks in America's financial foundation continue to widen, the next bond auction might not just raise eyebrows, it might raise alarms around the world. If you found this breakdown valuable, don't forget to like the video, subscribe, and ring the notification bell so you don't miss future deep dives like this one. It really helps the channel grow, and it tells the algorithm that people still care about understanding what's happening behind the headlines. Thanks so much for watching, stay informed, and I'll see you in the next one.